trading blog video, I'm going to take a look at trading futures versus trading the Forex market. Now, many of you that have known me for quite a bit of time know that I used to use FXCM as my Forex broker. And even with all the negativity that they've gotten out there in the press, I was still extremely happy with them. I had some of my best gains ever using FXCM. I had the automated strategy working, and it seemed like nothing could go wrong, right? I had my own little money machine. Everything was working perfect. Well, then they got fined and banned from doing business in the United States by the CFTC. And as traders, we have to be able to overcome obstacles like that. So at that point in time, I had two choices. One, I could trade with Forex.com, which my account was transferred to. The second one is I could quit using NinjaTrader and go use awhile. Well, both of those solutions, when I was looking at the bid-ask spread across the pairs, I wasn't that happy with. So I started looking for another solution, and I used to trade futures many years ago. I was trading futures a lot more than Forex, and then I really got sucked into the Forex market, and I was very happy with it. I found a home in the Forex market. Well, I found what I believe to be, a blessing in disguise. And what I mean by this is by trading futures, I'm going to show you guys a few pros that, one being that we have lower transaction costs. The second one is going to be a more transparent market environment. So let's take a minute and look at the charts. The chart right here on the left is a chart of the Euro, USD, and the chart over here on the right is a chart of the 6E contract. Now the 6E contract is a futures contract, and it's a contract for the euro dollar. Now if you look at the two price charts, I started them. Oops, this one got scaled a little bit differently. Now, the first price bar is a green candle. Same as over here. All of the candles look pretty identical to one another. Now, there are some subtle changes. All right, this green line here represents a prior day's high. Well, on this one right here, the market actually violated the previous day's high. The chart pattern still looks the same, but some of the prices are going to be off just a tad bit. But what would be the difference if we're trading this chart on the left versus trading the chart on the right? The simple answer is there would be no difference. If we were using a 20 pip stop loss on the euro dollar, we could still use a 20 pip stop loss on the 6E contract. Now, some of the currency futures do vary a bit, and when I was using FXCM, the euro dollar had roughly a 0.3 pip spread. So I had 0.3 of 1 pip for the bid ask spread. Well, when you come over here and we look at, I'm going to pull up this for an example, Forex.com, which is also offered by NinjaTrader, their typical spread is 1.3. So in the example in this blog post, I'm actually going to use a 1.2 pip spread. I'm going to kind of split the difference slightly. And let's jump back over to the charts. So when we want to place a trade in the euro dollar, we have zero commissions, all right? Our trading costs are reflected in the bid-ask spread. So for example, if the euro dollar is trading at 1.1192 and we have a 1 pip spread, well, if we want to buy this, it means we have to buy this at 1.1193.4 roughly, which is going to be up here a little bit, which, puts us a little bit underwater. Well, when we come trade the 6E contract, the futures market trades in ticks versus pips, but the prices kind of look the same. As you can see, when price is here, it's a little bit different on the futures contract, but, when I'm trading, I'm looking at support, resistance, zones, and, stuff of that nature. So I'm not really concerned with the actual price number. I'm more concerned with the market structure. The structure is going to look pretty close to being the same on both charts. Now on the 6E contract, it trades in half tick increments, which a half a tick, or you might see it as 1 tick, but When the 6E contract first traded, it used to be 1 pip would equal 1 tick, roughly. Now they have it where 1 tick equals roughly a half a pip, which is, pretty good. You may ask yourself, well, why is that so good? Well, the 6E contract roughly has a 1 tick spread. All right, so 1 tick would be half a pip. And that's a lot closer to what I was seeing with FXCM. FXCM only had a 0.3 pip spread, all right? But we also have to pay commissions. When I was with FXCM, I also had to pay a commission. But with the futures market, we have to pay a commission. So we'd pay a half a tick spread plus the commission. So when we come back over here, we can look and see what our all-in rate is. And I have a lifetime license, and I'm basing this on a lifetime license scenario. So if we look at the 6E contract and we come over here, we can basically see to get in and out of the trade, it would be $4.48. So just to, let's say we're in this example, we're just going to buy the 6E contract. Well, we'd have to pay $2.24 when we bought it. Then when we sold the position to close it, we'd have to pay another $2.24. And that's how this equals $4.48. So let's do some very simple math. We're going to do $4. Oops, I'm sorry. Let's clear that out. We're going to do, it's a half tick to get in and half pip to get in, half pip to get out, which is basically 1 tick. 1 tick is half a pip in the 6E contract. So our total transaction cost to get in and out is roughly going to be 1 pip, which is 2 ticks. So it's going to be $6.25 per tick. So we're going to round this up to $12.50, and that's going to cover the buy side and the sell side transaction. So totally to get in and get out, roughly we're going to pay $12.50. And this is all based on one contract, or in the spot market, we're going to use one standard contract. So $12.50 just in the spread. Now we have to add another $4.48 to that. Our total transaction cost is $16.98. Now, $16.98 may sound like a lot of money. Well, when we come back over here, and in this example, I'm going to lower this down a little bit to 1.2 because it says the typical spread is 1.3 in the euro dollar. So we're going to pull the calculator back up again, and let's take a look at this. So 1.2, all right, times 2, because we got to pay the spread to get in and get out. That's a total of 2.4 pips. Now we're going to times that by $10 because it would be $10 per pip. So we have a cost of $24 when we're trading the spot Forex market. Now, a lot of people don't think about, paying commissions or the transactions cost when they're looking at strategies, or, they're just thinking about trading altogether because they see, like over here, free, no commissions. Well, you are paying commissions in terms of the spread. So just because it says 0 commissions, don't think that you're not paying a transaction cost to put the trade on. Now let's look at this in terms of percentages, because trading is all about percentages. So we're going to take that $24 and we're going to minus 16.98. We have $7.02. That is to put on a futures contract of the 6E, and transaction cost, it'd be $7.02 cheaper. Well, let's divide that by 24. We now roughly have almost 30% savings by trading the futures market versus trading the spot Forex market. Now let's go back over and look at the charts. Now another distinction between Forex and, let's say, the 6E contract, trading the futures market. When you look at Forex charts, and you can check this out for yourself, but use 2 or 3 different brokers and pull up a chart of the Euro USD. You'll find that the highs are typically, could be as much as 1 to 2 pips off, or maybe just a couple fractions of a pip off, right? in between the different brokers? Well, when you look at a chart of the 6E contract, regardless what broker you're using, because it's traded on the CME, a centralized exchange, you will find that the charts are going to look identical to the tick regardless of the broker you're using. Now, this helps stops brokers from manipulating price and stopping you out when price really never went there, by widening the spreads, because everyone is seeing the same exact charts. Where Forex, we're not traded on a central exchange. It's all interbank related. So they can quote different prices depending on your broker and the level of liquidity providers that he has available to him. So that is another very good advantage, in my opinion, of trading the futures market. If you guys like this video, please take a minute, hit the like button, subscribe, and until next time, guys, good luck and good trading.